So we have actually seen the introduction part of business statistics or business mathematics, whereby we have said in business mathematics, your aim is actually to bring into perspective the operation of business, how business is doing its operation. Now, we are dealing with the terminologies. Which are these terminologies critical in the operation of business mathematics? Number one is selling price. The market price is taken to sell a product. So when you talk about selling price is a product of cost, profit, and taxes. So it is a product of cost, profit, and taxes, or interest, not taxes, interest. So when you talk about selling price, it is a product of cost, profit, and selling price. Cost price. The original price of the product is the cost price. So when you talk about the original price of the product, that is what you call cost price. So the cost of producing that product, the cost of making that product. For example, if you talk about the cost of a book, when you come to establishing the cost of a book, you must have established other different costs which were actually formed or informed in the preparation of a book. Now, which are these costs? We have the raw material, the cost of raw material, we have the cost of labor, and then we have the cost of overhead. Now, these are the costs which, when you bring it together, it gives you the cost of price, the price of a particular product. Now, leaving aside that, if you are buying this product from a particular wholesale or company, then you'll have the cost price, which identify your price of buying that product. Then when you sell this product, then you give the selling price. So cost price is a composition of raw material, labor, and overhead. Have that in mind. Profit. If the selling price is more than the cost price, the difference in the price is the profit. So when you talk about profit, as we know, the main aim of running a business is to make profit. Now, how do you get the profit? So the profit is the difference between the selling price and the cost price. So when the selling price exceeds the cost price, you make a profit. Loss. At what point are we talking about loss in a business? If the selling price is less than the cost price, the difference in the price is what you call loss. So when actually you're making losses in the business, the cause of your losses is because your selling price is less than the cost price. When the cost price exceeds the selling price, we talk about losses. And the aim of business is not to make losses, but the aim of every business is to make profit. Discount. What do you mean by discount? The reduced amount in the selling price of a product. So if your selling price is already given, for you to attract customers, for you to encourage people to buy your product, you must give them some discount. So discount is actually enticement strategy by business people to encourage their consumers to buy more products in lump sum and pay the amount in instant form. So the reduced amount in the selling price is what you call discount. Simple interest. Simple interest is that interest which is counted against the capital amount or the portion of the main amount that remains unpaid. So simple interest is the interest which is counted against the capital amount or the portion of the main amount of the remaining unpaid. Now, when you talk about simple interest, if you give loan, or if a business is given loan, they must pay interest. And this interest is charged on the capital. What is capital? So capital is normally the initial amount which is used by any business person to start a business. So you can't just start a business without capital. So when you initiate and borrow money from any uh, financial institution or from any other person, then you must pay them interest. So the interest that you are paying must be out of capital. Compound interest. Compound interest is the interest investment rate that increases exponentially. Now, when you talk about compound interest, this is interest which keeps on increasing as time goes by. So the first year, the interest is 10%. The second year, 15%, 17%, 18%. So your interest will always be increasing. That is why it is called compound interest. Interest which keeps on increasing exponentially. Another thing which we'll be looking at as part of the terminology is the present value. What do you mean by present value? Present value is the value of the item after considering the time value of money. After considering the time value of money. Now, what do you mean by considering the time value of money? Now, assuming you're borrowing money now and you're paying in the next 5 years. Remember, the value of money in now is different from the value of money in the coming years. So you need to factor in the difference so that if I pay you, if I give you my money now and you pay me back in the later years, it will be of the same amount. Remember, money never remains the same in value. So there is what you call time value of money. Always money loses its value. So the value of money now is not the same as value of money tomorrow. And that's why this is very important for us to know. If you borrow money today, what money is buying today and what money will be buying in the 20 years to come is different. Do you remember you used to buy a bread with 10 shillings? But now how much are you buying bread? How much is the price of the bread? I know we are all bread eaters. Yes? How much is the price of the bread? 55 shillings. Now, 10 years back, how much was it? 22. Now, are you realizing the value of money keeps on decreasing? So because there is decrease in the value of money, we need to factor in, we need to discount. That is why we'll be talking about discounting of money. There's what you call discount, how you actually get to know the present value. You do what you call discounting, no payback period, and then there's called discounting payback period. So that is when now we bring in the issue of present value. And then finally, we have the net present value. Net present value is the difference between the present value and the original value. The difference between the present value and the original what? Value. Again, let me bring into our attention that when you're talking about the net present value and the present value or the time value, this entails the purchase of fixed assets in a business. Assuming that you want to buy a machine now, again, we need to establish the productiveness of that machine. And with this in mind, we need to do what you call present value and the net present value. So the net present value is the difference between the cash inflow and the cash outflow. The present value and the original value. That is what gives us the present value. So when the difference between the present value and the original value is what we call net present value. When it is positive, it is good. When it is negative, it is bad for the business. So these are the critical terminologies that are necessary from now to the end of the session. We'll be talking about. This is where we'll be using our terminologies. This is where we'll be applying our knowledge. So we need to have this in mind as we discuss on business mathematics. These are languages that we'll be speaking. These are languages that are critical in business mathematics. So if you want to talk the language of business mathematics, then be ready to talk about selling price, cost price, profit loss, discount, simple interest, compound interest, present value, net present value. Are we together to that far? Any question as far as terminologies are concerned? Where are you not getting right? I can repeat so that you get it clear. Any question? So being no question.